The Federal Reserve, shaping a nation's finances since 1913. In the late 19th and early 20th centuries, the United States faced a volatile financial landscape. The absence of a central banking system led to a series of financial panics and banking crises, emphasizing the need for a more stable and flexible monetary system. The Panic of 1907, a severe financial crisis, underscored the weaknesses in existing financial infrastructure. Bank runs, liquidity shortages, and an inability to respond effectively highlighted the necessity for a centralized institution capable of overseeing monetary policy and regulating the money supply. In response to these challenges, Congress passed the Federal Reserve Act in 1913, marking a significant turning point in American financial history. The act established the Federal Reserve System, a decentralized central banking system comprising 12 regional banks and a board of governors in Washington, D.C. The Federal Reserve was designed to address several key objectives, including providing a stable and flexible monetary system, acting as a lender of last resort to prevent bank runs, regulating the money supply, and fostering economic stability. The Federal Reserve System structure incorporated a balance between centralized and regional control. The Board of Governors set national monetary policy, while the regional banks facilitated banking operations and implemented policies tailored to regional economic conditions. The Federal Reserve was equipped with various tools to influence monetary policy, such as open market operations, the discount rate, and reserve requirements. These mechanisms allowed the Fed to adjust interest rates, control inflation, and respond to economic downturns. The establishment of the Federal Reserve fundamentally altered the dynamics of the U.S. economy. The Fed played a crucial role in mitigating the effects of the Great Depression in the 1930s, and its role became even more significant in the latter half of the 20th century. Over the years, the Federal Reserve has evolved to meet the changing economic landscape. It has faced challenges including the stagflation of the 1970s, the savings and loan crisis in the 1980s, and the 2008 financial crisis, during which the Fed implemented unprecedented measures to stabilize the economy. Despite its pivotal role, the Federal Reserve has not been without criticism. Debates continue over its level of independence, transparency, and the effectiveness of its policies. The central bank's decisions and actions often spark discussions on their impact on inflation, employment, and financial stability. The Federal Reserve, born out of the necessity for financial stability, has played a central role in shaping the economic landscape of the United States. Its establishment in 1913 marked a departure from the financial uncertainties of the past, providing a framework that has endured and adapted to the challenges of a dynamic and ever-changing global economy. The story of the Federal Reserve is one of innovation, adaptation, and the ongoing pursuit of economic stability.